Okay, thank you, Luke. Appreciate it. And I'm Roger Betz. Of those who may not know me, I work for MSU Extension. I do a lot with the Farm Bill, especially in the commodities, on the corn and soybean program, the ART program, those kinds of things. Today we're going to talk about the Dairy Margin Protection Program, and my charge is to kind of give an overview of it, some of its review for some of you, and what the program, how it works and so forth. That'll take 30 minutes, maybe something like that, and then Chris Wolf will be here is here, and he will talk about a tool that we have to analyze it, the tool that we had before. That's been updated with some new features and so forth, so it's kind of an easy program to use. And I've already gotten on the spot. So a review, the protection program, it's a voluntary program, income over marginal feed cost, and that margin is between $4 and $8, and so if we get into that level, then it starts to make payments like insurance payment. It's the difference between the all U.S. milk price and national feed ration index. It falls below that 4 to 8. Protect dairy producers from severe downturns in milk price or rising livestock prices, or both. There's no production payment limits with it. There's 4 major steps in terms of thinking about it. What is your actual dairy production, or what is the actual dairy production margin? What is your actual production? Because it's all based upon what your actual production is and your actual history. You can choose on different covered production history levels, and we will talk about those different levels and so forth. And you can different premiums for the different levels that are involved with it. Production margin approximates milk revenue, overall feed costs for the farm. It's average over fixed 2-month periods. So it's January, February, March, April. So it's the average of January, February, the average of March, April. Divides the year into 12 equal units for the year. The calculations that are used nationwide, everybody has this exact same formula for the calculation of the feed, so it does not match your individual feed, those kinds of things. It's 1.0728 times the NAS corn price for that month, or 2-month period. Soybean meal price, Central Illinois, it's $1 per ton, and they use NAS alfalfa price to calculate what this 100 pounds of milk cost to calculate this margin. That's based on the 30 pounds of shelled corn, 106 pounds of corn silage, 14.7 pounds soybean meal, and 27 pounds of alfalfa hay is used in that ration. So this may not be your ration at all, it's just what's used nationally. Everybody's on the exact same playing field. There's no differences by county, by state. Everybody in the entire nation uses this exact same form. Whether in California, or Michigan, or Arizona, or Wisconsin, New York, they're all using the same value for the calculations. But there are regional differences, and so that is a consideration that we'll talk about later. This is looking at the, on the left side over here is the all milk price, and this is this weighted feed cost of the 3 numbers added together, the corn, soybean, and hay prices. And then over here on the right is the difference between these numbers, okay? And it's kind of sometimes hard to see what that difference actually is. You can see the spikes where the average has been. It's been as high as $14 during different time periods. It's been as low as almost into the $2.50, I think that touched way down here in 2009 and the 2010 year. Historically, very low numbers. The coverage area is this $4 to $8 margin between the whole milk price, all milk price, and this weighted feed ration numbers that they use. You can see historically where it's been, and again, this reddish color, pinkish color that shows on your screen is the area that you can protect with this option. $4 level is very inexpensive to buy coverage at that level. It's only a $100 administration fee, and it gets more expensive the higher margin that you protect and so forth. So think of it as an insurance program. We'll talk about that in a little more detail. Here's a potential lever count. Here's looking at the most recent numbers and so forth. Go back into the March-April time period of 2014. Here's your corn prices, your alfalfa, soybean meal, all milk price and so forth. Very high milk prices, and feed cost was relatively, compared to milk, was low, and so we had record high margins and so forth. April was 1387 and got all the way up to 1551 in October of 14. I think those are record numbers. I'm not positive of that, but Chris will talk more about that. We get here. Since then, it's dropped off. It's dropped off significantly. We got in the 15-year career at the edge at a 799 average price for January, February of 15. The March-April time period came right out at 750. We get into the May-June time period and back up at that 799 number. And we get into the July-August time period. We don't quite know what the August number is yet because we have to wait until the end of September before the August is actually published. And so we don't know exactly what that number is. It's probably a little bit lower than 799, I think, but I'm not sure. Chris can tell us more about that. So that's all the numbers, and looking at a little bit of history with it. Let's move on. Payments, of course, are made if this margin is below the coverage level between this $4 and $8 range, and so the last 2-month time periods would have been in the money here, a whopping a fourth of a cent or 0.4 cents and so forth. And we've been in the money at 50 cents in the March-April time period if you had bought an $8 coverage level. And so you got to look at that for what those numbers are. In order to calculate what you can cover with it, you got to look at your average production history. And it's the highest amount of the milk that is marketed, pounds of milk marketed, 11, 12, or 13. It uses those as your sort of like your base years. If you think about corn, soybeans, those kinds of things. Within each year, the 15 year, which was chosen in December of 14, you can choose which percentage of that production you want to actually cover. And those are in 5% increments from 25 up to 30, or 25 up to 90% of your actual production history. If you if you participated in the 2015 year at any level, even the $4 level and type number, you'll get a 0.87% increase, and that's the increase that occurred on the national amount of milk that was shipped or produced for the 15 year. I think that's for the 14 year, for the 15. And then in 2016 year, there's 2.61% of increase for the 16 year if you participated in years. Which years is that, Chris? Does it actually look?
You got the 0.87 times your production history.
Right.
If you signed up for 2015.
But that 0.87 is actually derived from what year's production?
That would be from the
prior years.
Prior year, right?
Yeah. And so the 15 numbers.
But as far as they're concerned, it's 0.87 times what their actual production history was, and then that again, if you sign up in the next year, well, if you sign up, you're signed up. So then they'll get another 2.61%. And if you haven't signed up before, it will be the highest up 2011, 12, or 1.0261.
And if the production goes down, if we actually have a decrease in the U.S. production, your level will not drop. It'll stay at whatever those levels are for the next year, thinking about 17 or 18, those type of things. So you can't go down, but you can go up. That's the way to think about it. Okay, there is a $100 annual administrative fee at no matter which level you go at, even the $4 level. That's due at registration time, which is now 11:20. It was the 9:30. That's why we scheduled this meeting for today, because we thought right at the tail end of the sign-up period. Well, then I think it was Tuesday or Monday of this week, they extended that deadline to November 20th of this year. In the future, we expect to be back to the 9:30. There's 2 tiers of payments depending upon the level of coverage that you're working with. It's called CPH, the covered production history. And the first 4 million pounds of what you decide to cover is at a lower rate than the pounds of milk that you are covered over the 4 million pounds. We'll look at some of those charts and so forth. Those premiums are due September 1 of the 16th, so it can be a ways off. And it also can, which is fairly new, can be taken from your milk check and so forth, and the co-op can actually write the check or transfer the money to pay for whatever level that you choose. Let's look at some of those different tiers. The $4, notice the $4 level The cost is zero. It's just a $100 administrative fee, so to speak. Whether you're in level tier 1 or tier 2, and the 450 goes up to a penny. The next 50 cents is 2 cents for that next 50 cents level for tier 2. And you can see the numbers and how they kind of work up. Notice that it is not a fixed amount for every change. It kind of moves around quite a bit in terms of the increase. If we go up here to $6, it goes from 4 cents to 5.5 cents at the tier 1, so 1.5 cents for that next 50 cents. Where this, where tier 2, that's 5.5 cents. That increase in the tier 2 for the amount of production coverage that you have over the 4 million annual production number. If we go to 650, notice we've got what, another 4.5 cents to go from, or 4.5 cents to go from 5.5 cents up to 9 cents. And if we go to $7, look at the change here. Now all of a sudden we got almost 22 cents of increase, 23 cents of increase in order to go from some $6.50 to $7 on the tier 1. If you go up tier 2 and look at this change from the $7 to the I'm sorry, from $6.50 to $7, that's 54 cents. So for the pounds of milk over 4 million pounds of coverage, from 750 I'm sorry, from 650 to 7, that 50 extra cents costs you 54 cents to do that. Okay, so think that through. So there's some very important levels in there in terms of what production level is. And the program that Chris helped develop helps us to look at those numbers and the what ifs and plug in numbers and so forth. So if you go all the way up to the $8 level, it costs you 47 cents. And if you go to the $8 level for the tier 2 milk over the 4 million pounds, it's $1.36, about 33 cents at extra 50 cents of coverage in the $7.50, $8, and then the tier 2 level. Questions, anybody? Okay. All right. The NASP prices are reported at the end of the month. The revised final values are issued at the end of the month. So if you look at right now, we're almost getting toward the end of September already. And so the August report, which is the July-August, is the 2-month period. That July-August final number is not known until the public until the end of September. Okay, so October 1, we'll know what the price actually is for the July-August time period. And then the payments can be made accordingly at 1/6 of whatever the annual number is for that time period. All right, questions on that? I'm just, yes.
Do you know if the potential for sequestration would hold up these payments, or do you know if that's considered essential if those would still happen?
Good question. I'm not 100% sure. I think, I'm not sure. Do you know?
Talking about sequestration or the shutdown?
Well, if the government does enter the shutdown, I know there's some, especially on the crop insurance side, some of that stuff's going to be deemed non-essential. So I didn't know if this was the same kind of deal for your FSA or if that was different.
I don't know if this is sequestered or not.
Well,
Chris?
that's two different issues. This is subject to sequestration in that when they make a payment, if they reduce it by 6.8 or 7.2, I never can remember the percentages. So when they did make a payment this year, they were lowered by the sequestration amount. The government shutdown, in some ways is related, but it's a separate issue. I don't know whether this would be deemed. First of all, hopefully we won't have a government shutdown, right. But because it doesn't benefit anybody as far as I can tell. But if we do, I don't know whether this continues to. But you know, if we do, it would be for no more than a couple of weeks, I would think, and then they'll catch back up later, right?
Well, yeah, I don't think it's going to affect the payment. The sequestration will affect the payment, but hopefully we do not have a shutdown again. Payments are scheduled. Well, I guess that's our PLC. So I guess I haven't heard. It would just delay it a couple of weeks. Whatever.
We're still going to pay it. It will just be delayed.
Yes. Yes. Get my programs mixed up there for a minute because we are like really busy trying to
figure out the ARP payments and stuff.
Is there a deadline on one of those programs from September 30th still?
Yes.
One of those?
Our PLC.
Yeah. Okay.
2 years, 14 and 15.
Okay, so again, it's 1/6 of the total number. There's no seasonality to your milk production, you know, what your history may be and those type of things. It's just a pure flat 1/6 is the amount it's calculated on, and you'd be paid the July, August time period. You'd be paid in October. You got to remember that you can participate in the livestock gross margin program or the milk protection program. You can't be in both. Those are both subsidized to some extent, and you can choose one or the other. Once you are in the MPP, you can't go back to the LGM type program. So once you're in, you got to stay in to the end of the 18th year, to 2018, I should say. Okay. Sign up was, as we said a little bit earlier, I think, was September 30th. That's why we scheduled this meeting as of today. But it got extended Tuesday, I think it was, to November 20th. You can sign up today, and then you've got until, my understanding is that you could walk in on the 19th or the 20th and say, gosh, I think the markets have changed, changed my mind what I want to do. And I can still walk into there and say, gosh, I think I want to buy a 650 coverage or whatever the choice might be. So you're not locked in today if you go in and get signed up. Those kinds of things, you can still adjust your decisions. As far as we know, future years will be that July 1 through September 30th. Once the producer signs up, they are committed to at least the $4 level. Higher coverage levels can be selected within each year. And so last year you may have had zero or zero additional. The $4 coverage cost you only the $100 administrative fee. You may have, this may be your first time for signing up, that's fine too. But once you're in, you gotta stay, but you're not locked into the price every year. You can change that level of protection that you want. If it looks like price is gonna be lousy, in terms of those margin goes, the relationship of the milk price and the feed price and so forth, and you're worried about that, you can buy a little higher coverage if you like. On the other hand, going into the 15 year back in 14, milk prices looked like they were pretty good, and so a majority of folks bought just the $4 level, and even that, gosh, the chances of that hit were pretty low, but they did buy the extra 0.87% increase that they got because they did sign up. So if you want maximum coverage in the future, it gives them just a little bit more coverage potentially if they want to. Okay. It's scheduled to end in December of 18 is the last year for the program. What's the downside of this program? Well, the numbers are fixed. There's no variability with them. These charts are identical for the 15, 16, 17, 18 year. In terms of the coverage levels you can select and or buy, and the premiums won't change, the levels won't change, period. It's a fixed numbers. So you can't lock in higher margins. For example, a year ago, you could lock in, you know, some pretty good margins through the LGM program if you want to use that as a risk management tool. It is based on national average prices. It doesn't reflect Michigan numbers or your farm's numbers, your local basis, those kinds of things. It is based on this flat U.S. numbers in terms of the U.S. all milk price. This fixed feed ration that's in there uses futures prices to determine what those feed cost is. That ration is fixed. Only floats the physical amount of that ration is fixed. The dollar amount is what changes based on where futures end up and then the hay price actually is. And you can only guarantee or not guarantee a production history level is the 90% level is the maximum that you can do. If you participated in 2015, okay, you must participate in the 16 years. It's not a choice. You must pay your $100, okay? Your choice then, if you participated in 15, for the 16 years, what level of protection do I want to buy? And what percentage do I want to buy? That's your choice for the 16 year. If you did not participate last year being the 15 year, the year we're in right now, decision made right at the end of last year, then you can choose to get into the program, or you can choose to do nothing, or you can choose to do some other risk management tools. But if you go in, you gotta stay in through the end of 18. Simple as that. So that's your choices, whether you're in last year or whether you're not in last year. You can use this tool to lock in a catastrophic type number. The $4 margin costs very little for protection. The odds of that, yes, I'll agree, are pretty low, but the cost of it is pretty low as well. For the 2009 year, we're going to do a little bit of looking back at how many dollars we have triggered in the back and using the tool that Chris worked on to look at some of those numbers, what the history brings to us in terms of how it would look. Think of it as an insurance program, and the simple way is to say it's going to cost me whatever that premium amount is to guarantee, if you will, using the national numbers and so forth, so much of your production at this $6.50 level or $4 level or $8 level, whichever level you choose, it's going to cost me this amount of money. It's like buying insurance. And it may trigger, it may not. Okay, you kind of hope that it doesn't trigger. It's insurance. Okay, but if it does, well, you know, then you got a trade-off in terms of what the benefits were versus the cost. And we'll spend a lot of time with Chris in terms of trying to look at those things and trying to evaluate based upon the projections in terms of using futures prices and so forth to kind of look at. And Chris, we'll spend some time on it. Of course, once you're in the milk protection program, the MPP, well, then you can't be in the LGM, as we said before. And again, a reminder in terms of the local basis, it's using national numbers, not your individual numbers, and so I just use the national numbers. Let's take a quick overview of the program, the actual decision tool. And there's, of course, the public tools, and that's the LGM program and then the milk protection program for dairy. You can choose one of those, but not both. And then you also have some private stuff that are still available, whether you're in or not. That can be futures contracts. It might be hedging the milk, if you're a hedger on milk, you're producing milk, you want to sell futures. You want to buy futures if you're going to hedge your corn and soybean meal. You might look at options as another tool. And if you're a milk producer and you put a put on those to protect the downside, you got the right to sell at some price with a put. You can do that at a cost when those numbers are published on websites and so forth. If you want to protect your inputs as a user of corn, as a user of soybean meal, you'd want to buy a call, okay? And that would give you the right to buy it at $3.80 corn or $4 corn or $4.10 corn, and you pay something for somebody else to assume that risk of the price of corn going up. And so you, as a user of corn, you want to buy corn. Of course, a lot of us you're producing your own crops and so forth. It makes a little different twist on it if you're producing crops. So the LGM programs and the milk marketing program, margin protection program, are both kind of isolating the dairy production side away from the actual crop side. So it's looking at it from the milk side versus the crop production. That's other risks that you have. It could be a risk mitigation, or it could be increased risk if you produce your own crops and so forth for the dairy. Of course, the worst case scenario is you produce your own crops. Market goes really high, you have lousy yields, like happened to some of us in 12, obviously. And so not only did you have to feed your cows, you had to buy expensive corn to replace the corn that you didn't have and so forth. So it made some of those margins in 2012 not so good as well, or 2009, and when the prices started going up and so forth. The drought that we had here in parts of Michigan, not everybody had drought in 12. You can forward contract with your different sources of feed and or milk. This program, it's available at dairymarkets.org, and it's very easy to get on. We're going to get on here, I assume. Really, the only thing you need to run this program is what is your actual production history. And you can swag it, or you can get it right off your records and so forth, how many pounds of milk you shipped, type numbers. And there's only really 4 steps to it. What is your production history? Kind of look at this whole scenario of what the margins kind of look like, looking at down the road, gain some experience looking at what we're going to do today. And the second thing, or third thing rather, be to select a coverage level. I want to protect 90% of my production. I want to protect 50% of my production of my history. That'd be my coverage production history then. And then you really can print and roll the form right off of this website, this tool. Simple as that. This is the front page to it. And the cover page shows some of the history of what this margin has been. Here's this number way down here in the 260 area for a little bit of a time period. Goes up and down and so forth. This yellow area in the middle, I think, is the middle third of the production, or of the margin over this time period and so forth. And we get over here on the left, and that's sort of what the projection is as of 9/9/15. That's September 9th. And this tool is updated every single night automatically. It takes off all the futures prices on milk prices, takes the corn price, soybean meal price, uses a number for the hay price and so forth, and this thing is updated every single night when we trade. So it's really kind of a neat tool. That's the front page. So Chris is going to talk more about it. I'm going to give you a little bit of a quick overview in terms of what the program does. The program will analyze both the margin protection program and also do the gross margin, livestock gross margin, the LGM program. That's the first step. You look at your coverage year. Whether you want 2016, you can go backwards and look at history and see, gosh, what would this program have done going backwards? Go all the way back, I think, to 2007. Go back to look at what the program would have projected, and you can see the actual as well. In your production history, we've got a farm that's got 1,234,567 pounds of milk. And so does this farm have to worry about tier 2 prices? It's way under the 4 million, so all of its cost of this program is going to be at that tier 1 level. If we get into a larger farm, well, then we may have to make some splits between how much is at the 4 million pounds and how much is above the 4 million pounds. And the program will do all those calculations automatically. Here is the results in terms of looking at the program. And the way to read this, if you look forward now, again, this is done on 99, it's going to be a little bit different today. What this percentage is saying is, if we look at a 750 margin on milk minus the feed cost, that margin at 750, and if we look at this July-August time period, that 2-month time period, based upon the current market as of 9/9 was when this slide was made, okay, there's a 28% chance that this margin is going to be below as a 750 or below. There's a 21% chance that it's going to be below $7, a 15% chance below $6.50, and so on. There's a 1% chance it's going to be below $4. Okay? There's a 1% probability that, but it can happen. Okay, it could happen. It's unlikely, but it could happen. Everybody understands that, risk and so forth, what's going to cause that, all kinds of things can cause that. This is a probability that time period less than 750. This is the same graph, or the same chart, if you will, the same table expressed as a graph. Here is the black line, is what the futures looking forward are telling us. Here's this July time period. It's saying, it's projecting that the price is going to be what? Around $9, maybe, someplace in there. It's halfway between here, about $9. But do we know that for a fact? No, we don't know that. What is the market telling us? The futures price is the black line. The 4 of them are involved. The all milk price, well, there's more than one of that. The all milk price, the corn price, the soybean price, the hay price. That's what those numbers tell us. But we use puts and calls and look at what the market is willing to bid to assume some of this risk. That's what puts and so forth do and call. based on that, and this is a 25% difference. I think that graph, if I hit my buttons, it'll kind of start to do that. Okay, so that's the predicted. And what this is saying is that there's a 25% chance that the actual dairy margin production margin will be above this number. So this is the two of these combined is the middle 50%. There's a 25% chance it'll be right in here, 25% chance to be above, a 25% chance in the red area here, and 25% chance below those ones. So this is the projection with a 50% confidence. I'm not a statistician today, type of stuff. It's kind of saying that there's a 50% chance it'll fall between the top of the green and the bottom of the red. That means a 50% chance it'll either be above or below. That's risk. That's insurance numbers. That's what we're talking about. Chris is going to spend some more time on it. Okay? So that's below the forecast. What's the decisions? Once you've looked at the income over feed cost, and that's what this kind of program does, the forecast margin. What are expected? What's the premium cost for a particular policy? What's the net returns based upon these probabilities and so forth? The program goes through and does that for us. You click on select coverage, or of course the program, so you can kind of look at that, and that's down here on the program at the bottom where you can see it in terms of that. No, that's what this is doing. So for this relatively small herd, okay, in a relative standpoint, 1 million pounds of milk, 1.2 million. We're looking at the 2016 estimate, and we've got a 90% coverage percentage. We did participate in 15 because it makes a difference on what your increase, that 0.87% increase that you're going to have for the 16. So that's a question in there as a toggle. So if we have 1.2 million plus 0.87% on top of that, which is what, 2 point something?
No, plus 2.6. They're both. It says you paid, participate in 2015 and paid the $100 fee penalty. That means this year.
Yeah,
So in this case, by November 20th.
Yeah, you gotta, that's fine. You gotta pay the fee in order to get the last year's benefit. So at 90%, you take 90% of 1.2, it's not gonna equal this number, but you add 0.87 onto it, then it would equal this number, okay? Because it's got the 90% plus the 0.87 on top, right? Which is
Plus the 2.6.
for the two of them. Thank you. I'm sorry. Yes, I'm with you now. I understand now. The 15 and the 16. So you're assuming they participated both years, you're getting both of those numbers. Thank you. I'm sorry. All right. So it's showing those numbers that are in there. Okay. And so then we go for it. I think this has got some numbers in here and so forth. You choose your level and what's the contract cost. If you put down here, it's $100 and so forth. This premium plus, that's what this number is showing. If you use those tables that I showed before, plus the $100 is what this number actually is. And you can look at then what are the estimated payments after the net cost. So if you look at this $8 premium, okay, at that level, protection level, well, that's kind of expensive. It's $5,563 is the cost of that. You're going to write that check. Okay, so that's the cost to protect 1,150,000 pounds of milk at a 90% level, which is that number. This is the cost to protect that many pounds of milk at $8. That's what it is. Well, then it looks at, based upon the probabilities, all those different charts there in terms of those numbers. The 1% chance is down below $4, the 28% chance it's going to be below $6.50 and so forth. It adds all those numbers up, and it says, well, based upon this point in time, it says that the expected payments are $5,657. And so the answer is, based upon that, expected numbers, he made $94. And that's reality. Okay? But we don't know what's going to happen. You could also look at what happens if we go to this 650 level. 650 level costs us $1,135 instead of $5,563 at the 650 level. Expected payments are a whole lot less. because we're only protecting the 650 instead of $8. But based upon those futures and those puts and those calls and the risk associated that the market's telling us today, that's got a 442 return. Plus, the risk of the numbers being down and so forth. The way to think about this, really, is this cost protect that number of pounds of milk at this price. That's what you're doing. And then it's got probabilities looking forward, those type of things. These numbers will not change. Doesn't matter what this number will not change. The cost of the program will not change over the life of this bill. Okay, it doesn't matter if we're projecting, $5 margin. We're nowhere near that kind of number. But if it did, the cost would be the same. The expected payment would be a whole lot larger. The problem is you got to sign up usually by September 30th for the next year. It's been extended to November 20th. That's a good thing, isn't it? Because we can get a lot closer to the market. We'll know more information then. I'm taking some of Chris's thunder, okay, by going on down the road. So that'll be good. Okay? He's got a lot more to add besides that. All right. You can also do historical forecasts all the way back to 2007 for the end of September. So it's saying what would the tool look like if the markets on that September 30th deadline, what was the market telling us about that next year? And you can go back and look at this to analyze how well is the tool actually working. And this is the 2014 for the coverage year and so forth. 2014 was what? A very good year for dairy. Right? And record high milk prices. Feed prices relatively were not as high as what the milk price was and so forth. The exact contrast, 2009 type numbers and so forth. The black line is what the futures and so forth projected with this 50% confidence interval, if you will, above and below. Here's what actually happened is the blue line. Of course, we got up in here, these 14 up into the $14, $15 ranges, almost pushing $16 as far as how high that actual margin got. So very, very profitable numbers, and now it's just bottomed right off, as we all know. Okay. So with that, I'm done, I believe, and we're going to turn it over to Chris Wolf from the Ag Econ Department here at MSU. Our state dairy specialist, and it looks like we're going to switch gears here. So I'm going to get out of the way.
I want to use web browser for a little bit and then go over. So what do I need to, I don't want to mess anything up here. Is it okay if I just use Firefox? Yeah. Do I need to share a screen or anything?
Go ahead and bring it up. You're in the browser, so just get another.
Okay.
Are we sharing, Stan?
Oh, yeah.
Okay. Question.
What's that? It was there.
Was it?
Yeah, it's on the right hand side. So there you go. You got it. Okay. All right, good. Thanks.
You're just sharing the screen, right?
Yeah, for now. We're gonna do the tool. Okay, so we're good, Stan? All right, thanks, Lou. All right, so I want to go through the tool a little bit, show you a few different things about using it, and then I'm going to talk about Outlook because a lot of you are probably signed up last year, maybe. More than half of the Michigan producers did. So your decision is not about sign up, it's about coverage, right? So that mostly is about Outlook. We'll want to do this again in a couple months. As Roger and said, when we scheduled these meetings, we were looking at a sign-up date that was in 5 days, and yeah. And now that they moved it back a couple months, that's good news in the sense that for this sign up, you'll have more time to collect information before you make a decision. All right, so what I have up here, hopefully it shows up well on the screen for the remote locations, is the dairymarkets.org website, which is the website that's hosted by Mark Stevenson, University of Wisconsin, who does a very nice job. It's a good website, actually, I think, for you to pay attention to anyway, if you want to pay attention to dairy markets. You can also get to this tool by going to the FSA website, and there's a link, or going to the National Milk Producers website, and there might be other ones that I'm unaware of. You can see that Mark's got it set up to scroll through market information. If you click on the Tools tab up here, that takes you to a bunch of market graphs and stuff. So we click on the MPP tab, and that puts us at the initial screen. So that's the margin protection program. And as Roger said, this is where the margin has been for the last 3.5 years. Is the solid red line. The middle third of where the distribution is longer term, which is essentially between 750 and 950, is the yellow band, and the dashed line is the current forecast, but we'll get into more detail. Now, if you click on the right-hand side on the decision tool, it takes you to a disclaimer screen that says what the tool is, what's new, and you have to click agree if you want to use it. And then we're into the screen that looks just a lot like what Roger was just showing you, but this screen is one Roger had was a couple weeks old because that was when we made the slides. But this is, as you can see up here, for the 2016 coverage year, so 2016 calendar year, calculated as of yesterday. So at the close of the markets, what this tool does is go and get the futures and options data for the milk, futures and options, as well as for the corn and soybean meal, and then calculate a projected margin. So I'm going to change the actual production history just a little bit, make it a little bit bigger. So this is where you would put in your actual production history, and that's the number that you started with last year. If you put in, and then this will automatically actually update it with the increases. If you participated, it will ask if you participated. If it did, it will increase it. So this is the highest of 2011, 12, or 13. That doesn't affect this graph at all. So right now, as of close last night anyway, and when I looked at the futures today, it didn't seem like it was moving a whole lot on the milk side. Anything happen on the corn or soybean meal side, Roger? Corn's up?
I think so.
Okay.
Yeah, sure.
Okay. Well, so we're looking at this. Here is January 2016, this vertical line right here. So there's the 2016 year from there to there. And right at the current time, it's projecting the possibility that we could have some margins below $8. And again, this is using those national numbers. So national U.S. all milk price, national corn price received, national hay price received, and Central Illinois soybean meal price. But it's looking like, if you look at this margin long run, over the last 15 years, calculated the way they've calculated using the U.S. numbers, the average margin is $8.55. So above that would, and actually a year ago, the average margin was $8.20. So last year was enough to pull that thing up by 35, 40 cents by itself because the margins were so high. But we're looking at margins that look kind of average for this next year. And this is always as of the most recent market information on the milk and the feed side. You'll notice that these confidence intervals, these bands around it, and of course there's 25% above and 25% below, these bands get wider as we go out in time because there's more opportunities for things to happen, right? If we have a drought in central Iowa next spring and into the summer, that will change the corn price pretty dramatically. It did in 2012, right? The drought in 20. So when we were looking at the 2012 numbers as of 2011, this program didn't exist. But if we had been, we would have seen that it was it was kind of expecting an average margin. But then when corn prices went to $7 and higher, which they did in June, July of 2012, then the margins got much smaller. And we ended up with some fairly low margins. Mr. Betz.
As I look at that, unless it's my eyes, it looks like the red is wider than the green. If that's an equal confidence interval, why is that different?
It is a little bit wider because it's not necessarily the distribution is determined by the options trading, And this would indicate that the market thinks there's a little more downside risk than there is upside, which given the relationship, and we'll talk about this in more detail, between U.S. milk prices and world all milk prices, there probably is more downside risk. Although it's probably a limited amount of downside risk because, frankly, with the amount that everybody's hurting right now in various places around the world milking cows, not a good time to be milking cows. Different story than last year. Not just in this country, but in other countries as well. You know, I got to think some production situation will change. But it takes a little while to turn it over, doesn't it? All right, so if we take and we look at the probability table, same information as this, just in a table form, okay? And so what this is saying is, so let's look at 2016. The expected, here's where the futures are, 887, 907, so up to $9.50. That's an above average margin. Given the basis relationship for Michigan prices to U.S., it's not probably an above average margin for you guys, because historically we had Michigan all milk prices that were actually a little higher than U.S. all milk prices, and Michigan feed prices in general have tended to be a little bit lower. But we have a situation now because of what's going on specifically in Michigan, where your all milk price, and more importantly your mailbox price, is much lower than the U.S. all milk price, which is an unfortunate situation, and it also means that you have a lower basis in this margin. Roger.
Just so I'm clear, when you say basis, you're talking about not just milk, not just feed, but the combination of those things is what makes up this basis.
Yes, we can think about a margin basis, but I would say the exact same story would be true whether we're just talking about the milk basis or the margin basis, because all of the downside, all of the decrease in basis in Michigan is happening on the milk side. So the market at the current time is indicating maybe about a 1/3 chance of below $8, about 20-25% chance of below $7.50, and so on and so forth. I would suggest that you watch this over time, this tool, and use it closer to November 20th, because things will change. So that's how I would look at that. Now, if we go select coverage, when you click that, it asks, so I've got this 8.2 million pounds of actual production history. It says, did you participate in 2015? And if I click yes, then it's going to increase it by 0.87%. Then it's asking, did you pay the $100 fee timely? That means for 2016, which is due by the deadline registration, so by November 20th. So if you participated in 2015, you are participating in 2016 and 17 and 18. And since you have to pay the $100 anyway, you should get it paid by November 20th, because you may as well get the production increase. Because if we do have a year that looks catastrophically bad in one of these years, and hopefully it doesn't happen, but if we do, you're going to want to cover every pound of milk you can cover. Would be what I would argue. Okay, so then that's going to multiply it by 1.0087, and then it will multiply that amount by 1.00261. Okay, so that's just what I told you it did. And so I've got this at 90% right now. This is an 8.2 million pound production history herd. Multiplying it by those two amounts and then that amount by 0.9 gives you a covered amount right now at roughly 7 million pounds. And that's what these fees and premiums reflect. If I change this, now I can get that down so I'm only covering 4 million pounds. There, 45%, I'm below 4 million pounds. Now I'm all in tier 1. And you can see it adjusts the fees and premiums at the different coverage levels. And then the expected payment is based on the probabilistic forecast of the margins from the futures and options market. Roger said this, but let me stress it. If you sign up for coverage at $6 at 45%, and this is your production history, this column here of administrative fees and premiums is certain. That's what you owe. You will pay that amount. This expected payment and then the expected net returns, which is this column minus this column, is probabilistic. And if you look historically, you'll see that some years, going into 2012, at the fall of 2011, we didn't expect it to be as bad a year as it turned out to be in 2012. And so the expected payments ended up being much higher, or they would have been much higher had it existed, okay? And then the opposite has sometimes happened. These numbers in parentheses means it's a negative number, right? Which means that payments are less than the fees and premiums. So you can use this to look at, and if you're above in particular, if you're above the 4 million pounds of production history, you might want to look at the trade-off between the percentage of milk that you cover and what level you cover it at. So coverage percentage versus coverage level. So this farm can cover 650 for $3,552 with an expected payment of $43.10, which might end up being no payment at all, right? So I would advise you to think about this program as a put option on the margin, right? If you've ever bought a put from milk, if you buy a put that gives you the right to take a sell position, right, with a futures contract. So in this case, you're paying these premiums for sure, and you will get paid if it happens to be below that. So in the sense, you're buying the option to have a payment. You hope, by the way, that you don't collect on this. It would be better if margins stayed high or even went up next year. And so, yes, Mr.
At
Betz.
that 650 number, you're showing expected payment of $4,310. And is it fair to say there's a 50% chance the actual payments will be less than that? And also a 50% chance the payments will be higher than that? Is that a fair statement?
Probably not exactly 50%. Because what the
that-
distribution looks like behind it. So this expected payment is the probability of each of the different margin levels occurring times what the payment would be at that probability. So if you had a 90% chance of $10, then that would be 9, and a 10% chance of $4, that would be 40 cents, and you would put them together. And that's how you come up with an expected payment. So these distributions behind it are log normal, so it's hard for me to say when you have multiple combinations of log normal distributions what exactly how it looks. But that's pretty close, probably, Roger.
It's close, but not exact.
Right. Yes, ma'am.
With the $6 coverage, you only gain $250 for your whole farm?
And this, keep in mind, we're expecting the average margins to be in that $9,950. So there's a lower probability that you could get below the $650. So, but let's take a look back at a historic one, okay? And we can do 2009 if you want to be scared. But let's not. Let's do 2012 because that's a little bit less scary. Also, 2009 was hopefully a once in a lifetime. So if we're looking at this as of September of 2011, so looking forward to 2012, here's what the market said. It was predicting some $7, $8 margins, not catastrophic, but not very high. If we look at it graphically, then it looked like this. So you can see that the average margin for 2012, which is right here, was in that $7 range and maybe expected to recover in the fall with some possibility that it could fall down low. That was before the drought actually happened. If we now go to select coverage, okay, then you can see what it would cost on those. And well, actually, you know what? I'm sorry. Let me go back here. And here's what actually happened in 2012. What happened was the drought occurred here, right? And we ended up in a I don't remember what did corn hit. Did it 750 in 2012? It was pretty high in July, August, right? Good time to be selling corn, bad time to be buying corn. And so the margins ended up being much worse than we expected. And so now let me go back here. Sorry. And if this is historic, then we can click include actual net revenue. So, it was expecting a bad year. So at $6, it would have been expected of $13.7. So an expected net returns of $11,570 ended up being 41. Would have ended up being 41. Okay. So, but keep in mind, I picked a really bad year. We can do the same thing, for other years. 2013, when we looked at it, was actually thinking 2013 was going to be a pretty bad year because remember, we're coming off of a very bad year in 2012. And it was a bad year until the last 3-4 months of 2013 when we recovered greatly into 2014. And so, you know, here $6 was, at the time of sign up, would have been expecting 26,000 because it was looking at a really bad year. It ended up being 4,300, so it ended up being much less. Still paid for itself. But if you think about this as an insurance policy that you don't want to collect on, then the fact that it's, you know, a small payment is you know, a good thing. You don't want to collect on your auto insurance. Roger doesn't want to collect, doesn't want his wife collecting on his life insurance. His wife might want to collect on it, but he doesn't want
One day that
collect
she
on it.
does.
So, did you have another question? Okay. So, so you can play lots of games here. Obviously, I think the one that you should spend the most time looking at is the 2016. And you can't click include actual net revenue here because it hasn't happened yet. But you can look at different coverage levels. And, you know, even if you had 16 million pounds of sales, if you covered only 25%, you would still be in that lower premium tier. Okay, so that's the basic tool, and you can look at the forecasting it, you can look at selecting coverage, and I would hope that maybe you'll look at it as we go forward here, we get closer to sign up. If you don't do anything as far as coverage election this year, you'll default to the $4 coverage on 90% if you're already signed up. And so if you don't want that, you'll need to turn in a coverage election sheet, which has CCC 782 or something like that. I can't keep it straight. Right?
Right.
So, and if you turn one in before, as Roger said, before the deadline, and then you decide to change your mind, you're allowed to do that. It's wherever you're at on the sign-up deadline date, right?
That's correct. Right. You can change up to through November 20th.
November 20th.
Which you need to pay that $100 though.
Bring your checkbook.
Even to get your bump. Okay.
Right. Then you don't. Then the premiums aren't due until, well, all of them are due the following September 1st, which is a change because before I believe 25% was due by February, and then the remainder was due June or July.
Correct.
Okay. And so this is a change where it's all due later in the year. But if you'd rather have it taken out, then they can make arrangements for that as well.
Right.
So, which might hurt less.
It could, yeah.
Mr. Betz, did you have something to add?
On the prior slide, you had 13, and it dipped down low, and then averaged up high. When it looks at those probabilities, does it do it for each 2-month time period or for the year as a whole?
Each 2-month time period.
So the probability, even though it dips, and it's not the average for the year. Gotcha.
Nope, it's doing it for each 2-month time period. That's also why it's widening out as you go forward. Okay, so let me talk briefly about the advanced tool, which is different this year. So if you used the tool last year, you may not have noticed this yet. I won't spend much time on it because we will get on to some Outlook. But if you click, so up here, we were at the MPP tab. If you haven't participated in the margin protection program and you want to consider LGM, you can click over here, and that will send you out to the LGM Premium Analyzer. This is the last month of LGM for 2015, because we're starting a new fiscal year on October 1.
We're into 2016 LGM right now. The LGM year is June and July.
Okay. Well, there's $3.1 million left this morning for LGM, for dairy. And the sign up, and this month, the sign up was tonight till tomorrow at noon or something. Tomorrow sometime. So if you haven't, you can go look at that, and you can look to, and keep in mind, LGM calculates the margin differently, so it's not apples to apples. So you can't look at an LGM margin versus this $8 one because it's using different prices, and you can change the feed weights on LGM. So if you want, you can line them up if you want, but you have to do a little calculating. But anyway, so MPP Advanced, if you go to the Margin Protection Program Advanced, you get this one, this screen, which hopefully if I go to 2016, will fill in the rest of that. There we go. So down here is the coverage year that you're looking at. You could do 2017, but there's only a couple months there. Doesn't make sense. All right. So this is the same, except for the labels are missing. Well, so what this is the all milk price. It should say all milk right here. This is the hay price, alfalfa hay price. This is the soybean meal price. This is the corn price. This is the total feed cost, which is the corn price times 1.0728, as Roger talked about, and then the soybean meal price times whatever that factor was. And this is the same thing graphically above. So this is January of 2016, 17.12 milk price, 8.39 feed cost. Take 8.39 away from 17.12, you get 8.73 as a projected margin. So there's your margin each month if you want to see it. Okay, monthly, and of course keep in mind that when the actual dairy production margin is effectively, it'll take the simple average of these two. So 8.73 and 8.84 is going to be 8.78.5. So anyway, this is the same thing graphically for where things are. And there's a slider here, so but these boxes here, you can enter your own values in. So if you wanted to see what it looked like, if you said you didn't believe where the futures market was, or you just wanted to see what it looked like at different prices than where the futures market currently was, you could go in here and say, you know what if this is 15 and this is 14. And so you can play with that, and this over here tells you what the average annual payment would be at the different coverage levels given what you put in here as a margin. So this puts it down to 715, and that's 581, which is just way too low. It's not going to do that. So let's do that. So you can change those, and then you can put it back where the market is. So, by the way, this average here is $9.01 is what it's projecting. I think when we started doing these meetings 10 days ago, it was $8.65. So it's up 35 cents in that period, mostly on the fact that class 4 milk prices have recovered a lot because of butter prices, which we'll talk about. So you can also take this slider on the side. There should be, again, I should have done this in Chrome. As a side note, by the way, when you're using this tool, Internet Explorer doesn't work great with this tool. Maybe it doesn't work great with anything. I don't know. But I have lots of trouble with this website on Internet Explorer, so I usually use Chrome or Firefox. And so I would advise you to use one of those if you can, especially if you're having trouble with this website. But anyway, we can click on, and this should say all milk here, and it's checked on all milk. So now I can use a slider to move the all milk price around too. And then you'll see that it lowers it to this, whatever level you slide it to. And so you can do that to look at what the effect would be. I think it's fair to say that we're reasonably confident on what the corn and soybean meal prices are going to be at least for the first part of 2016. Roger, is that fair? Unless something big happens at harvest, which we're not anticipating. So the action in the first part of 2016 is more likely to happen on the milk side, unless China decides to come in and buy extra. South American crop fails or something like that. So there's possibilities, but the milk side, I think there's more possibility for movement on, at least in the first part of 2016. Okay, so the other thing you can do, and I'm not going to spend time on this, but I will tell you that there are videos and user guides and books that papers to explain how to use it. If you click on stress test, then you get this right here, this screen right here, which you can use for your own individual farm. If you have balance sheet and income statement information, you can put in information about herd size, milk per cow, your expenses other than feed, because we're going to use the feed one as a proxy for feed here. Your worst case income over feed cost basis, which I would put maybe minus $1 in there now, or maybe even $1.50 for Michigan farms. Your other revenue and your production history. If you have any of your, if you're using futures options or forward contracts for your milk or your feed, and then your financials as far as working capital per cow, assets per cow, your debt to asset ratio, and it will project what your profitability situation is just what are we gonna put, $9 in there? Worst case basis minus 1. 250 in other revenue. Production history. Is that 4 million? Yes, good news. All right, working capital per cow, 600. I'm just making up numbers here. $7,000 in assets per cow because we've got some land. Debt to asset ratio, 40%. This is the worst cost. And I'm just quickly looking at this, but if you have balance sheet and income statement information, if you want to work on it, you should contact me, contact Roger Betz, Dennis Stein, Adam Kadrovitz, or a dairy agent to help you work through this. Go ahead, Roger.
I would just add that those of you that work with us with the telefarm system or the FinPack software, where we do the business analysis, at the end of the year, you will have those numbers.
Yep.
That divided by the number of cows and so forth. We'll have those numbers are available to you.
Right. So if you're already doing balance sheet and income statement type things on the fin end, then this number should not be difficult to pull out. And so given this information that I put in here, with this is expenses of a feed and this minus $1, the reason that we're putting the worst case basis in is that if we're thinking about this in a risk management sense, if it works at kind of the worst case scenario, then we should be okay. And so that's a much smaller, I'm putting a negative basis in there. I wouldn't have done that a year ago. I'm really kind of surprised at but that reflects the Michigan market situation right now, unfortunately. So right now what this is saying is, and these are the different coverage levels, given this data right here, it's saying the cash flow break-even margin is 750, and right now the futures market is projecting $9.08. So if we don't do MPP, we've got a net income of about 58 100 weight. Our working capital is going to increase, and our debt to asset ratio is going to go down. All that's good, great news. And if we did MPP, you can see that this basically, the net income gets lowered by the amount of premiums we'd be paying, because it's not expecting a significant enough payment to offset it. And working capital per cow grows not as much, and debt to asset ratio declines not as much. But then if you click adjust prices, if you said, geez, what happens if we get $1 lower on the milk price? Let's go just a little bit lower. Now you can see we got an average margin of $7, which is within the realm of possibilities. If you go back to the stress test now, it's looking at a small loss here, and you can see that if we had bought up higher coverage, we would have a smaller loss and we wouldn't lose as much liquidity or solvency. And so that lets you play with this as far as looking at what MPP could do. But you know what? That's not the only thing we could do. What if we hedged 50% of our income over feed cost margin at $8, which we might be able to do on the futures and options market? Now, if we do that, you can see that that helps restore us to profitability, although it's not a great year by any stretch of imagination. And so the other thing I would point out is that if you're doing a margin protection program, I would recommend that you still keep looking at other risk management activities, because there are some possibilities to get some margins out there using other tools. And certainly the margin protection program doesn't preclude you from doing this other stuff and can work in complement to these other programs. Are there any quick questions on that? I know that I kind of just flew through it, but I'd be happy to talk anybody through it that wants to do this. And as I said, if you go to the MPP tab on the Dairy Markets and Policy website, and there are materials on the side that can help you work through the tool, both the basic tool and the advanced tool. And we have farm management educators and dairy educators that can help too. So if there's not, I'm going to go back to the slideshow. Am I able to do that? Wait, where is it?
Just open it. Yeah.
I can open it? Okay.
Just
Want to look at what the chairs were doing? I'm kind of curious about
yeah. I'll be looking at it later.
All right. So is that
Go to the slideshow.
I'm sorry. What?
Over at the bottom. Slideshow. You want to go to the slideshow. Full screen.
Where? This?
Yep.
Right there. This one? Yep. Okay. Is that up there? Stand where you're at? Okay. All right. So let me just talk about Outlook a little bit with the time that we have remaining. And I wanted to put this up I got this from John Newton, formerly at the University of Illinois, one of the authors of the decision tool here, who's now at National Milk Producers. And remember when this program was put in place as part of the 2014 Farm Bill, that the dairy price support program went away. It stopped operating. It's still on the books, actually, and is part of the permanent legislation. So if they don't pass another farm bill, then it could potentially come back. Remember that whole dairy cliff thing that happened when we were talking about this? Because if we went back to the old price support program, it would be a percentage of parity, which was the price between 1910 and 1914, which would have meant a $40 a hundredweight support price. Okay, that threat is still there. It's just not operating right now. Okay, so that went away, at least for the time being. And the other thing that happened was the Milk Income Loss Contract Program, which you all may remember, also went away, right? It had been around since 2002. And so what John did here in this graph is look at what the Milk Income Loss Contract Program would have done had it been in existence now, and the answer is there wouldn't have been any payments in 2015, and there's none projected in 2016. So in that sense, nothing was given up there. There's some people that are not as happy with the margin protection program, but I think a lot of that, at least in Michigan, has to do with the fact that the basis has changed relative to the U.S. all milk price, which is not the program's fault. So anyway, let me go through that and get to the outlook. All right, so dairy market situation outlook. As I said before, here's the corn and soybean futures into at least until August of next year. Corn is on the vertical axis on the left-hand side, and soybean on the vertical axis on the right-hand side. So it looks like an increasing one, but hold on, take a step back and look at the scale. This is 375, and that's 425. Okay, so corn is projected, into the spring to get a little bit higher, but that's 25 cents, right? It's not a huge amount. And same thing with soybean meal. This is a 50-cent one. So at least at the current time, with what we know about South America and the world situation, it doesn't look like we're looking at extremely expensive feed if you're in the cash market. Bad news for Roger, but better news if you're buying it. Class 3 and Class 4 futures values. Class 3 is milk for cheese, obviously. Got the whey, dry whey in there. Class 4 milk for butter and non-fat dry milk. 2016 starts here. This high price of Class 4 is where we're headed based on the cash prices, because we have butter trading, as I'll show you in a minute, yesterday at $3.13.5, $3.13.5, which is 50 cents higher than we were last week, which is quite an increase. Been an exciting time in the butter market. But neither one of these, now both of these aren't good. They're not catastrophic enough to make big payments as you've seen projected from the tool, but they're not good. And so, and the situation is, it kind of depends on the farm situation, but probably coming in out of 2014, a lot of people had a lot of feed prepaid, a lot of seed and fertilizer prepaid, right? Because they were looking for places to spend money last year for tax management purposes. And so cash costs, cash flow expenses anyway, are getting higher, and probably won't be going into the next year with the same amount of cushion that people had this year. When I look at market situation and outlook, I think of my job as kind of looking at fundamentals and figuring out what it says, and then looking at what factors might be in play. 85% of the milk production in the United States is consumed here. Used to be 95% for a long time, but the last few years we've exported a lot more, so 15% roughly. Maybe we're at 14 something now. A couple years ago we were at over 16%. The biggest dairy exporters in the world are the ones that we want to keep an eye on their production, and that's New Zealand, it's the European Union, It's the United States. Those three are the big gorillas. Then there's a drop off. Argentina has some role to play, probably more in future years, and Australia also, but the most important ones are the first three. On the import side, China is the biggest single destination of world dairy imports and very important in recent years for the United States, but we actually export more to Mexico and we export more to Canada, and but we did a lot to China in 2014, in 2013 and 2014, but they backed kind of out of the market. So we kind of look at them. Russia here is a really big, important importer because they generally import between 25 and 40% of their dairy consumption. But 2 years ago, they decided that they didn't want to take it. They were going to cut off some imports because of that whole Ukrainian thing that we got uptight with them about, right? And so we actually have never exported very much to Russia on the dairy side. But usually Europe does. Germany and the Netherlands, a lot of cheese. And so all of the milk that was going into cheese that ended up in Russia has had to find another home. And it's been put into powders and things like that, and Europe is swimming in it right now, which is not good because that affects the world price, which affects our price. Dairy cow numbers have been really stable this year, so 9.32 million as a whole, and that's with high coal prices. So I'm assuming that people have been culling hard enough, and maybe they'll cull harder, and hopefully beef prices hold up, because that's what's going to happen to some dairy cows probably if these margins continue. And we didn't stop milking cows here in 2013. That was the last government shutdown with sequestration and stuff. The upper Midwest and the Northeast have been producing a lot of milk. That's the July year-over-year numbers, 7.6% for Michigan, which is a huge increase. That's over a year earlier, which was actually up over the year earlier than that, right? So it's a compounded type thing. Wisconsin, 4.4, is a smaller percentage increase, but actually even more milk, because Wisconsin produces a lot of milk. So you've got increases in the green area, decreases in the red area. California down 3% in July. There's the August one, California down 3.4, Michigan only up 4.1. But keep in mind, the long run increase in milk production for the U.S. as a whole is going to be less than 2. And for the state of Michigan is going to maybe be 3% longer run. So when we're at 4.5, we're 50% higher than the long run increase, and at 7, we're more than double. So this has implications for what we're building for dairy stocks. Okay, what's going on with that milk production loss in the West? In Southwest, is obviously drought. This is the 4th year drought. I'm losing track now. 4th year drought out there. Now the worst drought in 1,200 years. California is the 2nd biggest producer historically of corn silage in the United States, after Wisconsin. See, most people don't think of California as growing a lot of feed, and they don't necessarily relative to the 1.78 million cows that they have, but they still grew a lot of forages, corn silage and alfalfa. And a lot of the water that's been needed for the orchards has come out of, well, I don't know how I did that. Has come out of alfalfa and corn silage. And so there's been less of that available. They've had to ship more in if they needed it. And that has affected the feed cost. So these are NASS numbers comparing Wisconsin feed costs in August to California feed costs. You can see, and this tends to be, this NASS alfalfa hay price, you'll notice if you watch it over time, tends to be on the low side compared to what you'd have to pay for good dairy hay. At least pretty much everywhere that I've ever looked. So that says 260. That might not have bought you good dairy hay. Okay. Well, there's trucks doing that. So the comment was worth trucking, and I don't know what's going on this year, but a couple years ago there were at least flatbed trailers from Texas driving all over Michigan, seeing what they could buy. And I don't know what's going on this year, but certainly they're paying a lot more for hay. Look at the difference in corn price. Look at the energy cost difference. That $1.50 a bushel, and that's a lot. Roger'd rather sell his corn at $5, but I don't know if you can get it from California for that much, Roger. Probably not. All right, so what's the impact of the feed cost? This again is Wisconsin, California, and this is milk per cow per day. So California is the blue line, Wisconsin is the red line, and this goes back 5 years or so. And what you see is, so this is 66 pounds a day, this is 58 pounds a day, but for the last 2 months, Wisconsin is in the 63 pounds a day, California is at 62. That's the first time Wisconsin has produced more milk per cow than California since 1955. And Michigan's not on this chart. Michigan wouldn't fit on this chart because Michigan's milk per day is 72. So you guys are really good at getting milk out of cows. And Michigan is the top state in milk per cow per day. And Michigan is for a long time, for as long as I've been here anyway, I don't know how long, but for longer than I've been here, has been one of the top states. But now but usually Washington, California, Arizona, we're way up there also. And now Michigan is, and what's going on here, right? This is the effect on California of those feed costs. You just can't afford to feed them. I can't believe they haven't culled more cows. They're only down 2,000 cows over a year earlier, out of essentially 1.8 million cows. So I think that there would be some frightening balance sheets on the California farms right now. I don't know, but I would think that those feed costs, and so this is where you're seeing this effect of the feed cost in the drought is really showing up in milk per cow per day. All milk price. Wisconsin's is higher. Michigan's is higher, I think. I need to double check that for the last couple of months. Traditionally, I would have said without a doubt. The California guys are getting it on both sides right now, unfortunately. They've got a lower milk price. So especially if you think about it relative to the margin protection program that we're talking about, they've got a lower milk price and they've got a higher feed cost than the U.S. reference prices, which is kind of the worst of both worlds. All right, so what's going on? All right, remember this slide here? Where's the milk production increase? It's in the upper Midwest, it's in the Northeast. Where's the decrease? It's out west. That Arizona number was actually red the month before. Okay, so what happens? Well, what do we produce in the upper Midwest and the Northeast? We produce a lot of cheese, right? So this increase here, usually after the spring flush is when we turn down the last 2 months. So these last 2 months of increase, well, first of all, you can see how much cheese we had in 2013. That's just, but now we're above 2013. We're building stocks because the milk looking for a home in the upper Midwest has been going to cheese plants because that's where we have had capacity, and so we're just making a lot of cheese. Butter is a little bit different story. Traditionally, we produce more butter out west in the relative sense. We have butter churns here. There's one up the road, right? There's a butter churn not too far from here. But California, that industry out there was built on butter powder as far as what they did with their excess milk. And so we haven't built the butter stocks nearly as much, although, traditionally, this is still a pretty healthy amount of butter stocks. It's not low or anything. 2014 was a low number. And non-fat dry milk, we've got plenty of it. Normally, we would export a lot more of that, but we're not, well, we're borderline competitive on the powders. So dairy exports are very important. This is 2015 here. In the last little better than a year, we've seen almost a 2%. So this is the percentage of milk production that we're exporting. It's as percent of solids anyway, which is what we export. So it went from 16% in early 2014 when China was buying lots and lots of powders, and China backed out of the market. The European Union and New Zealand are producing more, and so this production is down almost 2%. That's a little bit less and not as steep, but in some ways similar to the decline that happened in 2009 with the Great Recession. But we have a much stronger domestic economy now, so that's really good news, right? So it's not the same thing, but this is a little bit disturbing, and this reflects actually the higher prices that we have here. This is by year the percent of the export values. You can see that mostly what we're doing is milk powder, which is the greens. And but what's going on? This is U.S. versus international cheese prices. The U.S. is the red, and these are NAS prices, so these are reported with a lag. So when the newer ones come out, this is actually going to trend down just a little bit here. Mostly because of the last couple of stocks report we've had, where the cheese stocks have been building at a fairly fast rate. But we have been this year, for the last several months, kind of out of alignment, where we've been at $1.70 per pound for cheese price. The world has been more like $1.40, $1.45. So that's not a huge discrepancy, but that does make us less competitive when you're trying to. And you see, if you look at the numbers, that since early spring, we haven't really exported cheese if it wasn't CWT subsidized. So we haven't been sending a lot of cheese overseas, and this is actually what you see is going on here. This is 2015, the cheese exports kind of tailing off. Butter is the really interesting one. This has 3 different butter prices. The red is the US, the blue is the EU, which is put on there as a range, high-low, and the green is New Zealand, is Oceania, and world prices usually are Oceania. That's what we use as a reference location for world prices, because that's the traditional big surplus area that everybody can import from. This is a year ago this time. We had $2.85 butter, and was $1.50 higher than the New Zealand price. This says $2.40. This is with a lag. Cash prices today, which is a small market, but it's an indicator of where the other prices are going, were $3.13. They were $2.65 a week ago, so we're up 40, 50 cents in a week. This is the time of year when, if you are making something with butter for the holiday season, if you're ConAgra or General Foods or something like that, and you need butter, if you don't have you got to get ready to have ready for Halloween, Thanksgiving, and so on. And so if you don't have it, you've got to get it if you've got the contracts to deliver. And this kind of looks like people being a little bit freaked out about the fact that they may not have enough butter. Also, butter consumption's been strong. You know, McDonald's now, right, is using all butter. Well, I don't know how much that changes butter consumption, but we probably could figure it out. So while the world market has been down here in the $1.30 to $1.40 range, we're at $2.40, and it wouldn't fit on the graph. It would be up here at $3.13. If you are New Zealand or the European Union and you want to import butter into the United States, you're allowed to import a certain quantity each year without paying high tariffs because of agreements that we have, but it's not a big quantity. If you want to import above your tariff rate, then you have to pay 50 cents a pound, is the current tariff, or tax, if you will, on imports. When we are $1 to $1.50 above the world price, you can afford to do that. And so if you look at the butter imports, you'll see that the last couple months they've been increasing. It's, market's working. So our strong domestic demand has been helping. And so here we are in 2015, we're essentially not exporting any butter. The only stuff we're exporting is CWT subsidized. But in a way, we shouldn't be exporting it because the market is saying it's really valuable here, keep it here. Global dairy trade, 2015, this is the Global Dairy Trade Index that Fonterra runs in New Zealand, which is what you may have seen in the news a month or two ago because Land O'Lakes pulled out of this trading here, because I don't know exactly why, but they pulled out of it. But this is New Zealand's attempt to get the big players in the world market to come there and start using that for trading, for indexing world prices. And it usually is a leader of world prices. And the last 3 trade sessions has been up after being, this is an index, so you have to have an index to a previous period. The last 3 ones have been up after reaching a catastrophically low level. So have we reached the bottom there? I hope so. If you want to look at comparing prices of the three major exporting countries, well, counting EU as a country, the EU bloc, if you will, which is 28 countries, adjusting it to 4.2% fat, because that's standard internationally, and adjusting it for exchange rates, which also matter when you're talking about trade. The red line is the United States, the green line is New Zealand, and the blue dotted line is the European Union raw milk price. You can see this is as of a couple months ago, which is the last time it was available. Okay, it wasn't 1838 here, but at 4.2% fat, that's, you know, that helps on that price. But still, just for comparison on the same terms here, 1838 for the United States, 1361 for the European Union, and 1061 for New Zealand. New Zealand has a low cost of production because they are seasonal grazers, and they don't have as big of investment, most of them, in facilities, and they're not feeding concentrates. But 1061 is a low milk price no matter what you have. That's very low milk price, and you know, and it's been catastrophically bad for them. It's like 2009 was here right now in New Zealand.
That number like $2-3 a hundredweight lower cost in New Zealand?
Probably. Yeah, that's, you know what, it's lower than ours, but we've been more competitive with them in recent years as far as our cost of production. Fonterra, which is the big New Zealand co-op, the general dairy, there lowered the milk production forecast for the next year for New Zealand by 2%. And that's also, by the way, coincides with this bottom right here. When Fonterra lowered that, then we saw global dairy trade index recover because New Zealand is that important. Now that's 2% down off of what was a pretty big increase, like a double-digit increase the year before. But New Zealand is really sensitive to weather, being grazing, right? If they have a drought in New Zealand, so we're coming into spring there, right? If they have a drought, that would move world dairy markets quickly if they have an adverse weather event, because they're very dependent on that. I don't know if that's going to happen. Well, I don't know what does El Nino do to New Zealand? Does it do anything? I don't have any idea. But it might. Does it affect them at all? I don't know, because it's off of coming off of the Pacific. So
It's pretty moderated environment.
So they had a drought 3 or 4 years ago, and it really showed up in the milk production. So something like that could happen, but those are very, very low. The other thing that's not helping our imports at this point in time is this is the U.S. dollar index to other major currencies. A higher dollar, so the more that line goes up means the more it costs other places to buy our goods, but the cheaper it is for us to import things, and the dollar is strong because the U.S. economy is strong. In particular, strong relative to like the European economy right now, where there's still a whole lot of uncertainty about places like Greece and other places. So did you have something, Stan? No? Okay. So that's not helping our imports either. If the dollar got weaker, then it would be more expensive to buy stuff from China, but we'd be able to sell more stuff. So that wouldn't hurt. So in the European Union, I told you, is about $13.50 a hundredweight. Milk price, the estimates, the cost of production that I've seen put it at 18. So that's what, losing $4.50 a hundredweight. That's 2009 here also. A lot of people losing $4.50 back then, if you recall. Support price is $11.20. That's not helping them. Milk production quotas come off, and their milk production is up 2 or 3%, and they're projected. The EU is projecting it to be up 2.1% next year. But you know, at some point there'll be a response. You know, because people are hurting there, losing a lot of money. They're not used to losing money. They're not used to a volatile milk price, which they're having to deal with now. They haven't had to deal with in the European Union. Russian embargo, as I mentioned before, that was really bad timing. They recently announced $560 million in dairy farm aid, but that's spread against lots of countries, and it's mostly concentrated in the Eastern European countries that are most directly affected by the Russian embargo. They also announced that they were going to do more storage, which would be similar to our price support program. So this is pictures from the European Union headquarters in Brussels last month. European farmers are much better at protesting than you guys are. And so they drove the tractors in and lit some hay on fire, and they had a tub grinder that I don't know if you saw the video, that was kind of interesting. The police were lined up and they had the tub grinder that they put big bales of straw in and were shooting it at the police. I don't know if their police had guns though. They have less guns there. I don't know if that would work as well here. But so honestly, the situation is very very serious financially, both in New Zealand and the European Union, and unfortunately, in some places certainly here, and getting more widespread here, I would say, right? So that's not good. So El Nino, the weather forecasters say strongest El Nino in 50 years from what I've seen. Last time we had a really strong El Nino, I think, was 98. And if you may recall that had a big effect on milk production in this country, because a lot of farmers in California in the Central Valley were using dry lots then, and there were cows that drowned. They had big milk quality problems because of all the mud. And actually the result of that experience was that lots of dairy farmers out there built freestall barns that hadn't previously had them. So I think perhaps it will have less of an effect there than it did in 98. It will certainly help the growing situation there, but what they need is, well, slow, steady rain for a long period of time, and not a big, hard rain that would run off. Are we going to have a mild winter? Now, the El Nino would suggest, right, that it's more likely to be mild. I think the Farmer's Almanac says it's going to be colder, right? Who reads Farmer's Almanac? Stan, did you read that?
I did not read that.
It was in the news that they said it was
Being up north would be okay with a little milder.
You're going to deal with, you like the little milder in Antrim County?
Yes.
Well, at least I think it was last week in the news that Farmer's Almanac was saying colder than normal, which would be not consistent with the El Nino. And the one I saw was some people from the Farmer's Almanac getting a little defensive about how they come up with their forecast versus the other forecast, but will be interesting. A milder winter will mean less of a decline in milk production in the colder parts of the country, and probably a little more alleviation of the in the longer run of the feed cost issues out west, but not in the short run, because they're not going to get any more feed for a while. Cull cow prices are off from their highs, but they're still pretty strong, right? Anybody culling cows lately? What's the price recently?
87 cents.
87? Oh, that's down more than I had heard before. Is that recent? How recent is it? 87 cents.
Wednesday.
Wednesday. Okay, that's pretty darn recent. Okay.
But fat steers have dropped down below $1.30 for fat steers.
Have they? So, well, they were pretty high for a long time. It would be nice if they stayed high for a while.
Yeah, up $1.10 at one time.
But that's a good price. Dairy product, milk prices. These are the August prices that NAS reported. Cheese $1.74 for the United States. Butter $2.04. Non-fat dry milk 74 cents. Dry whey 31 cents. That's really low. Really low. That's cheap protein. You look at it versus the September 15th world prices. Cheese $1.45, and that's up 12 cents from the month before. Butter $1.41, and that's up a dime. Non-fat dry milk, and as you can see, we're competitive on the powders. Okay, which is the only thing we've been really exporting a lot of. These prices right here, cash, result in these class prices: class 3 16.27, class 4 12.90. If you plugged in these prices right here, all four of these, you would get a $3 drop in class 3 price and $1.50. But that's not what we've been doing. Cash butter of $3 a pound this week, which doesn't mean that will be the NAS one, right? Because they average it over the weekend. This is the cash, which is on 4 loads trading in Chicago type of thing. But it's still, those cash ones are the reference price that everybody uses to set the wholesale prices, so it matters. But if you put $3 in there and leave everything else the same, that's what you get $18.28. And actually, if you look at it, that first graph I showed you, it has class 3 at $17.50. Of course, we won't be $3 for the month. We'll be $2.80 or something, which will get us in that $17.50 range. But that also means that class 4 for the next couple of months will be the class 1 mover. So that's good news too, because they set class 1 off of the higher of. And there's your spot butter prices. That was before the trade today. That was 310 yesterday, 313 and a half today. So, and so what happened was we got to, you know, the end of July, the beginning of August, and this is where they start looking at the inventory and seeing if they're going to have enough to fill the holiday orders in. And so the question really is, when they get these holiday orders filled in the first usually 2 weeks of October, if history is any guide, how much are they going to back out of that market? And I don't know, we haven't had McDonald's make this announcement before either, or other things like that. The news all seems to be good on butter the last couple of years, right? As far as encouraging consumption and stuff like that. So that's, you know, so that's different than it has been in past years. Cash cheese prices. This is as of last night. We had been sitting there at about $1.70. This is on blocks, which is the more important one. Barrels is down here. Usually there's about a 5-cent difference between blocks and barrels. It's gotten pretty wide a couple times and then come back. But the last couple days we've dropped down in that $1.55 range from, you know, $1.74. All right, so the current outlook, the U.S. economy is strong, and that's good for consumption. Dairy product retail prices, with the exception of butter, have been down recently, encouraging consumption. You know, hopefully we'll see a lot of cheese on sale or something, and people will eat a lot more pizzas and things like that, and because we need to get rid of some cheese. But that's good, strong, it's helping consume products. It's you know, we have 85% of the milk production consumed here in New Zealand. Exports 90% plus of their milk production, so they're really at the mercy of the world market. We have the world market mattering on the periphery, but important. Exports is going to continue to be an issue, except for the powders, where we're sitting at world price. You know, we're not going to export a whole lot of cheese, but well, maybe cheese, because cheese prices at $1.55. We're starting to get closer, aren't we? We're getting closer to the cheese prices. So maybe if they recover a little bit, then we're competitive again. And the butter ones, the butter is going to be the big mover when we're looking at it. I think that there's more, although I'll tell you what, when I started looking at this a couple weeks ago, the margin has gotten a little stronger, mostly on lower feed prices and on higher butter prices. So I still think there's more downside risk in that margin, if you're looking at it, than upside risk. You all have 2 more months to decide on this sign up, but you also, in the meantime, can be also, if you are so inclined, looking at futures and options and forward contracts. And there's some margins in early 2016 that might end up, that you might want to consider locking in some percentage of the milk production. Because I still think, at least for the first half of 2016, there's more downside risk there than what the market would currently indicate. You know, we're coming off the highest margin ever in 2014. Average margin is right in here. Rarely are we at the average. It seems to be a good year or a bad year. We've been in the boom or bust cycle. So, you know, right now the market is saying we're going to be, you know, here. So maybe more like a 2011. But there's lots of things that will change in both the feed and the milk market in the next 16 months. So what should you do on this margin protection program? Well, this is a couple of examples looking at 2 different strategies of coverage, as if the program had existed, which of course it didn't over this period. It didn't last part of 2014, but it didn't the rest of the time. But just for illustrative purposes only, this is 1,000 cows, 23,000 pounds of cow at 90% coverage. So fairly big herd at a high level of coverage. The revenue maximizing strategy, which is really not a risk management strategy, and this is what's perfect hindsight, right? If you had, this herd would have been better off 7 years out of 10 being at the $4 level, paying their $100, and that's it. The other 3 years, 2009, 2012, and 2013, the optimal level to be at was $8, at which point payments, had this program program existed would have been very, very high. And so that optimal strategy pays an average of 37 cents over that time period, over that whole time period. Okay, 650 if we just did that every year. And remember, Roger pointed out earlier that 650 to 7 was the point where the premiums took a jump. So a lot of people look at 650 as kind of potentially a sweet spot. If you just did that each year, then this farm would have paid a lot of premiums each year, $52,000. But remember, it's a big herd, 1,000 cows, and we're covering it 90%. But in the 3 bad years, it would have more than made up for that, to the, so that it would have been a positive $333,000 roughly dollars over that period of 14 cents a hundredweight. So, you know, we're going to get much closer to the year before you have to make a decision. You're going to have a lot more information than you do at this point in time. If margins decline a lot or look like they might, then you might want to consider increasing. Here's what the sign-up was for 2015. Michigan, 53% of the herds. U.S., 51%. You can see California, 70% roughly of the herds. Idaho, 66. Texas, 71. So the South and the West signed up more of the herds than we did in the upper Midwest or the Northeast. In general, Minnesota was higher. This is the percent of the contracts at each of those different coverage levels for major dairy states. So even though about 70% of the California herds signed up, 71% of those, of the ones that signed up, this is percent of contracts now. Okay, so not percent of milk, but percent of contracts. 71% of the 70% of the herds that signed up were at the base $4 level. And the same thing with Idaho. So the Western guys signed up more, and most of them were at that catastrophic $4 level. And if you look at Michigan, 52% of the sign-up was at the $4 level. About 1/3 of the Michigan contracts were in that $6 or $6.50 right before it made the jump, and only 1.8% at the $8 one. 48% then, so 52% were at $4. 48% bought at some level above $4, and 23, roughly a quarter, bought at some level above $6. And you had to be 8 to get a payment this year, right? And at that $8 one so far, you wouldn't have gotten enough back to cover it, to cover the expenses that you paid. That's a good thing. That means the margins have been above, and they're going to be above. Well, we probably will have the small payment for August, September, or July, August. Then we got September, October, November, December. Those look like they'll be above, so there won't be a payment. But we'll see. An issue then for Michigan is, as I mentioned earlier, this is the Michigan all milk price minus the U.S. all milk price, so the Michigan all milk basis, if you will, okay, to use that term loosely. Historically, we expect the Michigan all milk price to be 40 cents on average, although you can see there's been lots of variation. But the average difference is 40 cents above, and Michigan has traditionally had a higher price than the U.S. all milk price, which is good relative to this one, because that means when you're protecting such and such all milk price, you're actually protecting a slightly higher Michigan price. Not true in 2015 because of what's been going on in the market and all the milk trying to find a home. It's been a minus 45 cents on the all milk difference, and that's an average because this number right here, this number right here is minus like 75, I believe. So instead of a positive 40 cents, it's a minus up to minus 70 cents. That's a $1 difference there in what you're looking at. Which means that the effective coverage level, if that is the relationship this next year, is less than what you would expect it to be. Looks more like what the California guys have had to look at for the coverage level here. And this is actually Michigan all milk minus class 3. And again, all milk is like the mailbox, but without the hauling taken out. So the all milk price would be about 80 cents higher than the mailbox, because in general, well, the average numbers that I have anyway would suggest it's in the 80 cents or a little bit better per hundredweight hauling cost. And yours would be a little bit different, probably, depending on where it's going. But still, this basis here between the Michigan All Milk and the Class 3 long run has been a positive $1.80. It's been 32 cents average in 2015 for these months, and that went negative here to minus 50 cents or so. So instead of looking at a, so now, you know, the last couple months you've probably been looking at a negative basis relative to the Class 3 futures for the mailbox. And you know, if you're budgeting for this next year, that might be what your creditor is suggesting that you do. Is look at what it looks like at minus 50 cents or a dollar, which is not good. And hopefully this is not a long run situation and that it turns around. But something to keep in mind. So what decision should you make? Well, we don't tell you what to do, but hopefully the information that we talked about today is useful for talking about, for making this decision. Hopefully you'll look at the tool, talk to your farm financial advisors, talk to your extension educators, talk to your co-op people, and watch it as we go towards November 20th for sign up. And I didn't leave a lot of time for questions, but I'm willing to stay and talk if somebody has questions that you want to say anything from FSA.
Yeah, we have Linda, a record here from the, I don't know how many counties, 5 or 6 counties she covers and so forth, and she's been very gracious and always gotten along very well with our sister agency and so forth. And so, Linda, any comments that you might want to make? You're welcome to have some time.
Well, I think both Roger and Chris covered pretty much the program itself. I just, again, sign up ends for 2016 on 11/20 this year. At the very least, get your $100 in before that, because you lose coverage until if you pay after that date, then you're only can pay the $100. And that's if you were in 15. If you didn't do it and you're not in the program at all, you're not entitled till 2017. But if you were in 15, get your $100 paid, because you are dropped down. All you can have is the cat coverage, and then you can't earn that for the next 2 consecutive months. So again, get your $100 in by the 20th of November. Again, the premiums aren't due. If you do the premiums, then that's not due until September 1st of 2016. So just give us a call and get in and get signed up if that's what you want to do. That's really all I really have. Well, in the sequestration for 2015 is 7.3%.
And for 2016 it goes down a little bit, doesn't it?
I
Like
don't have that
6.8 or
information
something.
right at
But it's in that 7% range the whole time. And that would affect payments that came out of this program.
And hopefully we don't have a shutdown. So if we do, we'll see you when we get back.
Point of clarification, the ARP payments, which are coming in October, that's a 14 payment sequestration number. So that's 7.2. But the Dairy MPP program is the 15 money. So that's 7.3. I just learned that talking to Linda.
Okay.
That's where a lot of this confusion is.
Yes, well, I don't think the sequestration would make your decision on this, but it is there. Stan, are there any questions from, did they all quit by now?
No, there's still on. I haven't seen any questions come through yet. But you can announce that if you'd like. They can hear you better.
Oh, can they hear me? If there's any questions, please put them in the chat box or whatever. And hopefully questions relevant to what we're talking about here.
That'd be great. There is one in the Q&A.
Oh, there is. There is. Do you know how to do it, Stan?
You can bring it up on the screen too.
Oh, okay. Get out of the way.
You need to answer it. Or actually, it just says, thank you.
Oh, okay.
Thank you, Dennis.
All right, thanks, Dennis. Yeah. All right. Well, is there any questions here? Anything that you guys would like to talk about?
Will in November.
Well, you know what? We'll probably be doing some more Outlook, and we won't necessarily be going through all the tool in the background, but I think that there will probably be some Outlook meetings in early to mid-November. We're going to want to look at that and have this conversation again. Play with the tool maybe and do some more Outlook, and so we will definitely, from Extension, keep you informed on that. Because I'm thinking the second week in November we probably should, maybe we do another webinar and maybe go to a couple locations. So, but absolutely. But meanwhile, you know, watch the markets, watch the website.
Chris, is there any indication as far as this disparity between Michigan and the rest of the country? And is there anything we can look to that is any kind of a silver lining at all, or might give us any indication as to when this thing's going to come back to normal basis or historic?
Yeah. So the question is, what should we? Is there any signs that we can maybe have this situation where the Michigan price has a negative basis relative to the whole milk price, or even this class 3 price with a big negative PPD on some checks? What can we look to? And I think that the answer in the short run is, well, what would help is so what caused that is just the massive growth in Michigan milk production and the expense of finding a home for all of this 6 and 7% milk increases, which coincided, unfortunately, with, you know, normally about 30% of the milk in Michigan leaves the state. We don't have processing capacity for all of it, but normally Indiana needs milk, their deficit. Ohio needs milk, their deficit. Florida needs milk. And if we have to, there's excess processing capacity other places like Pennsylvania and Wisconsin. But everybody's up this year. Indiana hasn't needed the milk that they needed. Ohio hasn't needed the milk that they normally. Florida didn't need as much milk as they normally did. It wasn't as hot there this summer. And the Wisconsin plants being up so much, there's less capacity there, and so there's been less of a home for it. And what we need is a growth. At least one of the things we need is an increase in processing capacity in Michigan, because, you know, at least then you could convert it to something and put it away for a little while if you need to, right? And so, you know, like cheddar cheese, for example, gets better if you store it. I like old cheddar cheese. And I think in the short run, that processing capacity, you know, it takes a little time for it to change. I think there's a lot of people working really hard to try and make that change, but it's going to take some time. And so, and in the short run, I'm afraid we might be stuck with that relationship for a little while. I think there's a lot of people that are looking at different options. Certainly, I mean, what you want a silver lining, the silver lining is perhaps that some big dairy processors are really looking hard at Michigan as a place that's for long run growth, that they think that they could come in here and operate. You know, Michigan is now number 5 state in milk production since the last 2 or 3 months. And Texas is declining, Michigan is catching up, it could move even higher. So, but that doesn't help you in the short run, that doesn't pay any bills.
Thing is, we knew this a year ago, what was going to happen. And no sense ever looking back, but I think we did a poor job over the last year to realize this situation could come about. Whenever prices seem to be high, this is when everybody wants to expand, right? You see the price so high last year, I guess just start buying a lot of cattle from other states to bring them in here. Then the price goes the other way. No different plant corn. Corn at $7, Jesus. I guess we all better plant corn. Right, but how long will this last? I predict it'll last another year.
That you probably right. I mean, as far as I can tell, there are still several facilities at the very least that don't have any cows in them yet that have gone up, that are going to be looking for cows around the state. Did you have something to say, Stan? Did I? Yeah, this one's here.
So Dennis had put a question up here. He said that they have an FSA handout at their location that has a different premium price today for the 750 coverage in the greater than 4 million pound. So Dennis isn't indicating what that number is, but it might be slightly different than our PowerPoint. I'm not sure why. And we're looking that up, Dennis, but if you want to pop it in there, you can. I'm guessing it's not hugely different.
Well, you know, it certainly is possible that I made a typo there. I'm not exactly known for my typing skills.
Could be a little transposition or something.
So that certainly
it says $1.06. Is what it says on Dennis's sheet.
It's certainly possible that I have the wrong number in there, that I either typed it wrong or didn't account for the fact that there was 25% discount last year. So, yeah, I would take FSA's word for it.
Assume you heard that, Dennis. Thanks for pointing that out. If there's no other.
Oh, wait, yeah, go ahead, close it up. I'm gonna give you guys.
If there's no other
Evaluation, if you wouldn't mind taking 2 minutes to fill out an evaluation, I appreciate it.
questions from the remote site, we'll go ahead and stop the recording and close down the meeting.
Thank you for
Thanks for
your attention.